Every day, every single day, things are happening in the world of deals and deal makers. And there's never enough time to keep up with every company, transaction, announcement, or whatever. It's just exhausting. And we have a new product to help fix that. This is Axios Pro Deals, a new premium subscription product bringing you tailor-made insights like never before. For the last 5 years, Axios has helped deal professionals navigate the whole deal landscape with Pro Rata. With Axios Pro Deals, we're diving deeper into the industries that matter most to you. You just want stories on fintech? There's a newsletter for that. MedTech deals? We've got you covered. The future of retail? We'll guide you. With Axios Pro Deals, you're going to be getting all of this industry-specific insight and expert analysis at a level you simply can't get anywhere else. So if you're a venture capitalist, private equity investor, banker, trader, founder, executive, anyone who cares about deals, Axios Pro is what you need to help you understand what matters and why. Start your free trial today at AxiosPro.com. Welcome to our M&A in Today's Market virtual event, part of our Dealmaker series, where we've covered the changing financial, regulatory, and cultural landscape for deal makers, investors, and founders. I'm Dan Primack, business editor of Axios, coming to you from my home in Southborough, Massachusetts. Big welcome to our audiences on Facebook and Twitter and YouTube, and LinkedIn, and of course, Axios.com. And please be sure to join today's conversation on Twitter with the @Axios and #AxiosEvents. Over the next 30 minutes, I'll be joined by my colleague, Kia Kokliacheva, and we'll look at what's in the pipeline for the M&A market heading into 2023. We're joined now by Kirsten Green, founder and managing partner of Forerunner Ventures, joining us from San Francisco. Hi.
Hi, Dan. Nice to see you.
Nice to see you too. So let's start kind of big here and then maybe work our way down. The purpose of this entire event is to talk about the state of M&A. So specifically when it comes to kind of venture capital backed startups, what is the state of M&A right now?
Well, I think that this year, this is kind of, in some ways, it is a really good environment for M&A. It's an environment where people are coming out of the pandemic with strong balance sheets and valuations are in flux. And in the most part, particularly in the public markets, they're obviously down and depressed. And so I think that it's a time where strategics are thinking about, is it opportunistic time for us to go in and access new channels of business, form new partnerships? And I think from the other side of the table, companies, I imagine, are looking at a depressed price and wondering if now is the right time to accept some interest in their business. If they, have this, as many good options to continue on their own, or if a partnership would help them. Those are obviously very individual answers, but I think that, a change of time of uncertainty is always an opportunity for people to really take a hard look at what the best alternatives are going forward.
Let's dig into that a little bit. So when you talk about pricing for the private markets, right? So you're right, the public markets, you have a stock and the price is what the price is. On the private market, I'm curious, do you feel that founders, CEOs, boards are accepting the idea that their company is now worth 20, maybe 30% less than it was before, and are actually willing to engage in M&A talks there? Or is there a little bit of, I don't even want to say, delusion, but is there a bit of, the public markets are struggling right now, they will come back kind of like they did in March of 2020. Don't sell now, let's wait.
I mean, I do think that people are slow to accept the reality that the value of their company is something different or less than it was before. But the longer
is that the reality though? Is that the reality when you look at your portfolio, I guess, and you talk to your founders? Is that the message you're saying to them is that last price you got from a venture round, that's not really what you're worth anymore. And it's not because you've screwed up the business, it's because the market's changed.
Yeah, I mean, I think that like you can't, I don't know that it's fair to universally look across your portfolio of all companies, operating in different categories at different stages and say to them, they all need to be written down X% because the market's down. But I don't think it's as simple as that. But I definitely think it is on everybody to reflect on where the market is today and to be realistic about that. Just in the same, in some ways, in the same way that the couple of years ago, we all accepted the valuations that the market was giving, which were arguably too high. So, I do think that, it is an art in private companies in a lot of ways, particularly at the early stages. At the later stages, you can track more to kind of your own math and your own multiples and what's going on in your sector and have some relative, view on your company and its growth prospects relative to the public companies. At the early stage, that's harder. But I do think that there's enough conversation about it at this point in time, and there's enough uncertainty in the market coming from so many different directions, whether that's from consumer sentiment, whether that's business sentiment, whether that's the interest rate outlook, the global stage, the stock market, where you have to kind of, I think, take a step back and be realistic about the environment that we're in, and if you have to raise capital in the future, like what the impact might be and how to try to set yourself up for success in that realm.
You said in an interview recently, a couple of weeks ago, that you are having more fun now than you were in the last couple of years. And I read that and I was like, that's like somebody saying they prefer the hangover to the party. So explain to me why you're having more fun now than you would have been last year or the year before, when everything was a bull market and everything anybody touched turned to gold.
Well, listen, fun is maybe too loose of a word, but I would say that I feel like this year is a lot more constructive. And I think we're having, a lot more success engaging in real substantive conversation with companies. The last couple of years was, there's always good business being done. I do think that's true. I think we've been doing that at Forerunner, but the market had a layer of euphoria around it. And certainly people, feeling like, there was a tremendous amount of opportunity. There was a tremendous quest for growth. There was a tremendous quest for hiring people, and capital was readily flowing. And what that equaled up to was a lot of deal activity and a lot of very competitive processes, which I think competitive processes are healthy, but not when they're driven by over exuberance and people just anything to get at the deal. And I think there was some of that, if not too much of that, in the market. And it's hard to keep your energy up, and it's hard to keep your discipline up in that market and still do really great deals. Versus this year, where you're having a lot more conversation about the business model, the business environment, how you might navigate challenges ahead. Where is the flexibility in your business? How can you be nimble to meet the market? And and really use the capital in a very ROI driven way.
I asked earlier about this idea that some founders maybe haven't quite internalized a lower valuation for their companies. Let me ask you from the venture capitalist perspective, and obviously as a usually minority shareholder, you don't have final say, but you might be on the board, you might have a vote on some of these things from time to time. How do you navigate your own pressure? Because you also have investors in your funds, and they've probably been seeing over the last several quarters, last several years, markups because venture rounds have gone up and up and up. How do you kind of balance that on your side if there is an acquisition offer for one of your companies that's lower than where your limited partners expect the company to be worth?
I'd like to think that our limited partners respect us and trust us as the general partners who are in the day-to-day of the operations and really assessing like the ongoing current state of the business and the market that they operate in. And so we try to, kind of keep an open mind in those conversations and really think about what is the best setup for the company, both from a perspective of being able to access an opportunity today, or how long it might take you to access an opportunity down the road and what that could look like. And a lot of times it comes down to how the founder is feeling about the business opportunity and what their drive and interest is to continue and how they think the business can be best set up for success in the next chapter.
You talked earlier about consumer confidence. Forerunner is known for doing a lot of consumer-facing investing, even though also the firm's moved a lot into B2B. Is this particular upcoming holiday season more important than the last one, or are they all equally important?
Holiday season is always important to any company that's selling a good or a service. I don't think this holiday season is much of any different than another holiday season on a relative basis.
It's interesting. One of the trends in Silicon Valley for years and years was that founders had not only control of their company, but they never left. They stayed as CEO forever. And in the last year or so, we have seen, and your firm has had a high profile example of Glossier, you've seen a lot of founders step back from their companies, either into executive chair roles or leaving altogether. When that happens, should that be a signal to the market that the company is, if not for sale, willing to be sold?
Absolutely not. I actually think it's really good hygiene that it's becoming more kind of acceptable practice for leadership transitions to happen. The person that starts a company versus the person that takes a company public, the skill sets that are needed in that those two different ends of the spectrum are really, really different. Some people are wanting to evolve in that way, able to evolve in that way, and invest in learning that way over time so that they themselves are becoming a very different leader over time with different capability sets and surrounding themselves for success. And other people uniquely like different points in time and different challenges and different needs of the company. I think the best leaders have a good amount of self-awareness around who they are, where their strengths are, and a good awareness around their organization and what their bench looks like and what their company needs at a point in time. And to me, the best founders have the broader interests of the company in mind. And I always tell the founders that we work with that one of the ultimate signs of having created real value and real opportunity going forward is to be able to attract really strong talent to continue to come into your organization. And nothing could be truer than at the CEO level.
Kirsten, thank you very much for joining us today.
Thanks for having me, Dan.
And next, we have our View from the Top segment with Axios Chief Business Officer, Fabricio Drummond.
Thank you, Dan. I'm Fabricio Drummond, Axios Chief Business Officer. Thank you to our sponsor, Cooley, for making this conversation possible. I now have the pleasure of hosting a conversation with Jamie Kathleen Lai, partner and co-chair of M&A at Cooley. Jamie, welcome back to Axios.
Thanks, Fabricio. Really a pleasure to be here.
Oh, thank you. Jamie, last year, you and I connected and markets were in a very different place. We were seeing record-breaking deal activity, soaring valuations. Fast forward to 22, we're seeing a pullback in the public markets, a slowdown in venture financing. What are some of the shifts that you're seeing as we head into the last quarter of this year?
So from a macro perspective, Fabricio, we're unfortunately not expecting a major sea change in the fourth quarter. 2022 has been a volatile, albeit fascinating, year for us, and many deal participants are simply in ride-it-out mode. That said, in the tech and life sciences space, where we love to play here at the Cooley firm, we are experiencing some important momentum in key areas. One, in the tech sector, we continue to see the consistent lure of platform building, talent acquisition, and product acquisition, albeit at lower multiples and deal ranges. In the life sciences sector, some target companies are now incented to head off near-term financing gaps. And for buyers, there's now an ability to hunt targets with less competitive valuation pressure. Across industries, we see late-stage private companies looking very attractive as partners for PE funds to pair with adjacent portfolio companies. And I'm an optimist, but I see a glimmer of hope for some public stock-for-stock deals returning in the not-too-distant future when we see consensus build around the new normal in valuations. Now, as you know, Fabricio, the M&A market is driven heavily by the confidence of boards and management teams. So I have to say that the M&A market outlook remains a little cloudy, given that general market volatility and management teams focused on internal performance rather than external value add like M&A.
And then given this volatility with valuations and reluctance, what impacts have you seen in exit strategies for companies that are looking to sell? Are you seeing an increase in private equity buyers versus strategic corporate buyers, for instance?
So let's remember that many core buyers are behind the scenes doing smaller tuck-in deals, particularly on the strategic side. These are mostly for cash, so they're easier to finance, and they fly under the radar for regulators. Today's buyers are looking for bargains, immediate accretion, or bolt-on products, and there's way less competition for assets in the marketplace today. So this is an opportunistic window for savvy, confident buyers. Now, on the sell side for strategics, well-funded companies are not in the market to sell. Most are hunkering down with adequate cash on hand to focus on core competencies until better valuations return. I would note an exception here, and that's fatigue, management and key leadership fatigue specifically. The frenetic pandemic pace, followed by the pressure to be well prepared for any potential recession environment, has really created more than one tired management team. So boards are taking a hard look at that to see that they have core teams in place to continue leading through the volatility ahead. You asked about the PE side of the house, and of course, the big story here is financing. It's currently a challenge to have confidence in the debt markets or consistency of equity checks. That said, our PE buyers are more active in the public markets than ever, given the decline in multiples. And one last thing to continue to watch for the PE set is that as investors shift their demands to reward profitability over growth, there's a lot of appetite for PE to take public companies private. Now, if you're looking to sell to PE as a company, you better have a healthy acceptance for reduced multiples. And remember, when markets do stabilize, we expect a blistering pace from PE, given all of the dry powder under management.
And per Refinitiv and other sources, the tech sector has accounted for about a quarter of deal activity in the first half. As we're in the second half and kind of headed towards the end of the year, do you continue to see the tech sector leading the way, or do you see the winds changing?
So at the Cooley firm, we always believe that tech and life sciences lead the way. But in all seriousness, the macro environment is hitting all segments and industries with the same force. There are two competing features specific to tech I think worth highlighting. One is a headwind, the intense antitrust and regulatory environment potentially quelling deals or deal psychology. But two tailwinds. One, we always ride large waves of M&A following early periods of explosive growth and innovation. So fintech, e-commerce, e-transportation, crypto, SaaS consolidation, all still very active. And of course, the tech space is home to the most innovative and disruptive minds out there. So these are not players ready to sit still for very long on the deal sidelines.
And as many people like to say, in the midst of chaos, there's also opportunity. What are the companies that are successfully navigating this M&A market doing well?
I would say preparation is the name of the game for those successful companies. We're spending many hours with our clients getting prepared for potential activism, ESG scrutiny, and potential hostile or unsolicited activity. That strong plan for boards and exec teams is essential. As we've seen, no company, not even our dual-class companies, are immune to the headwinds of investor sentiment. And in the tech sector in particular, there are a number of characteristics that are often ripe for activism playbooks: excess cash on the balance sheet, current market underperformance, founder dynamics, et cetera. And many of the current activist campaigns include a sell the company refrain. For the buy side, we see a number of our clients using this downtime to reassess strategy, looking at easier regulatory footprints, realigning target priorities or the order of acquisitions. They're going after smaller targets with a renewed commitment to integration and path to accretion. And they're making plans for effective execution of larger deals when the markets get a little brighter. Remember that no strategics are sitting out an entire market cycle, so they are behind the scenes getting ready. Now, on the sell side, I think there's a sober assessment of cash and operational needs. While many of our tech and life sciences clients financed well in previous years, for those that are facing tighter times, it's essential to get out ahead of strategy in advance of any pressure to sell. Now, one thing to watch, particularly for our VC-backed companies, is alignment on valuation. Matching investor expectations with the reality of current multiples will be interesting to watch, particularly with those massive financing rounds that were loaded in towards the end of last year. Now, personally, I'm keeping an eye out for a possible uptick of merger of equals. I think these deals lend themselves to a really interesting 1 + 1 = 3 transformation story, and I anticipate we'll see a few more over the coming months.
Excellent, Jamie. Thank you for joining us and sharing your insights. And we'll look forward to continuing this conversation.
Fantastic. Thanks, Fabrizio.
Thank you, Cooley, for making this conversation possible. Kia, over to you.
And I'm Kia Kokolacheva, Axios Tech and Business Reporter at Axios. Our final guest is Vice Chair of Global M&A for Citi, Christina Moore, joining us from New York. Hi, Christina.
Hello. Thank you so much for having me. I really appreciate it. And I'm delighted to be able to talk about this topic.
Thank you for being here. So let's just dive right in. I know you're not a big fan of just saying M&A is great because that's your business, but give us an honest, sort of quick assessment. Where are we at in the market right now? What's going on? What are people feeling right now?
Well, thank you. I think it's an excellent question. And I think that, when you look at this year, it will have proven to have been a good year, not a great year like last year, where we had global M&A volume of about $6 trillion. But we're on par to have the kinds of volumes that we had pre-pandemic. So I would say in the 2017, 2018, and 2019 era. If we stay moving forward the way we have this year, we could get to about a $4 trillion market globally. However, I think that we have to acknowledge that volume has, that this year was in some sense front-end loaded, that volume has slowed, in particular through September, and that we may not reach those levels, obviously reflecting the level of uncertainty, both in terms of the progress of the economy, the volatility in the stock market, the increase in interest rates, and of course, fears over what's next. So I think that in summary, a good year, maybe not as good a year as pre-pandemic, but certainly constructive in terms of the tone of the market, with a bit of a pause later in the year.
So let's kind of dive a little deeper into that. What are your thoughts on what's actually driving the slowdown? Why are we seeing less deal making?
Well, I think that there is obviously the uncertainty with respect to both the progress of the stock market, the progress of interest rates, and certainly some of the geopolitical triggers have slowed deal making somewhat. I think that that's temporary, however, and that when you actually start to look at the prospects for extraordinary values in this market, that I think that we will begin to see at least the level of conversation increase. It will still, there's obviously a lag between conversation and action, and certainly as both buyers and sellers find the right price point, there will probably be some give and take, but eventually I think there will be price discovery that will allow the market to proceed more or less at a normal level. That being said, the real question you're asking is, what's the likelihood of a recession next year? And I will leave that to the economists, but what I can tell you is that even during recessions, and we've looked at, our financial strategies groups have looked at deal making during all of the recent recessions going back through the last 5. And what we see is during a recessionary period is a decline in deal making. We see a decline in the merger market, somewhere between 25 and 30%, but we continue to see robust transaction volume, both on the strategic and the financial investor side, reflecting lower volumes and reflecting the progress of those transactions once they're made.
Right. I mean, we've seen a number of big deals this year, so clearly some people make some. Diving a little deeper into that, what are, deals are being made. What do you think are the reasons for that? Is this a period of bargain hunting for acquirers, or do you think these are conversations that started such a long time ago that folks are just, committing to them and seeing them through?
I think that if you look at what has happened so far this year, it's clear that this year was driven by technology, which, depending on whether you're looking in North America or globally, was somewhere between 35 and 40% of the volume. Certainly, it was driven by financial sponsor interest. As you probably know, financial sponsor cash on hand is at the highest level it's ever been. It's around 2.4 trillion, which is multiples of where it was in 2017 at about $1 trillion. So we've seen a lot of financial sponsor activity. And obviously, with that technology and financial sponsor activity, we've seen a lot of activity in the industrial sector, and it's largely been a big deal market, with deals of 10 to 20 billion outpacing all others, and then of course right behind it is the $5 to $10 billion range. So the first half of this year was quite strong and was based on a slightly different set of forward-looking metrics, but still quite strong. Looking forward, I think that what we'll see is that as prices as volatility begins to if volatility begins to subside, what you'll see is that corporate acquirers are always have historically used these types of recessionary periods to build their business. And if you look at this from the perspective of a corporate acquirer, it's really about building their business worldwide, adding to their capabilities, and indeed continuing to grow their corporation to the benefit of their investors, employees, and stakeholders. So M&A continues to be an important part of every corporate toolkit through recession. In fact, when you look at the history of transactions that are done during recessions, they've outperformed those during the great class of M&A transactions. They've actually outperformed deals done during recessionary periods have actually outperformed transactions that were done during the over all periods by about 3 times. So it's a remarkable time to think about, for corporations to think about expanding their businesses, looking at transactions that might during a more aggressive equity market might have been out of reach, and to begin to build their business together with capabilities that might be more expensive to make today than to buy today, given the correction in the market. So all of these things, I think, contribute to a robust market. Not once we probably go through this period we're going through now, I think we look forward to a relatively robust market. Certainly the global economic environment does weigh on that, but the progress of deal making doesn't stop, even if there's an economic slowdown. And in fact, it actually gets a little better.
Right. And so thinking about it from the point of view of companies who might get acquired or who would be more of the profile of a target, how are they feeling these days? Do you think that the sort of the tightening of availability of venture capital and that kind of stuff is making them maybe more amenable to being acquired? We talked a lot about uncertainty. Maybe they don't know what the next couple of years looks like in terms of financing, and going and hanging out at an acquirer's business sounds like a good deal right now. How are they thinking about it?
Key, I think that's an excellent question. And when you think about where corporations are today, around 25 in North America, at least around 25% of the S&P 500 is trading at its 52-week low, and that does weigh on both the minds of corporations and certainly on boards of directors in the context of an approach from another company. We also see that in many sectors, and in particular, as you know, I do a lot of work in the tech, in media and digital media sectors. Some of our clients are down as much as 60 and 80% from their highs of last year. So certainly that dynamic of when can I get to a stock price that allows me to continue to use M&A to fuel my growth, reward my employees, to operate in the same way that I have historically, that becomes a real challenge. And in some cases, I think companies do start to think about, is there a better platform on which I can build the capabilities that I've already built over and above what I do today? So I think that obviously there is some disappointment around the progress of the equity markets, but I think there's also a certain acknowledgement that in many cases, what they've built is quite valuable, and it probably makes sense to monetize that as part of a larger platform today.
We've got a few seconds. Any one prediction for 2023?
I think we'll see investment grade strategic acquirers continue to dominate the picture. I think we'll also see transactions from financial sponsors that have probably a little more equity or a little more creative financing. But I think that this, no matter what happens in the economy, there'll continue to be a robust and vibrant global M&A market. And I look forward to all of you being part of it.
Well, we'll have to check in with you next year and see how that panned out. Thank you so much, Christina, for joining us.
Thank you very much. I appreciate the opportunity.
Thank you all for joining us this afternoon for another virtual conversation that has made everyone smarter, faster. For the latest on M&A or to sign up for the Axios Pro Rata newsletter, visit axios.com/newsletters or on the Axios app. And to access our exclusive subscribers-only news for professionals who need deeper reporting and analysis across venture capital, private equity, and M&A, subscribe to Axios Pro at axiospro.com. Thank you all for joining, and we'll see you at axios.com.